Long straddle. This is where you buy an at the money put as well as an at the money call with back-to-back strike prices. You use a trade like this when you think the market will move sharply, but you're not sure which direction to expect. In other words, it could either go up or it could go down. You just think it's going to go somewhere, do anything but stay where it's at. It's a good position to use when the market has been flat or trading in a narrow range. The profit potential is unlimited in either direction. At expiration, the break-even is equal to the strike price plus or minus the net amount paid for the spread. The risk is limited to the amount paid for the spread. In other words, you have to take the premium you paid for the call as well as the premium you paid for the put, add those together to arrive at your break-even point. The maximum loss is reached if at expiration the market is at the strike price that you purchased. In other words, right in the middle. Now here's an example of a straddle, an option straddle in the Eurodollar market. Here we're buying a 96 call and a 96 put. They're both March options and they're back to back. Now, to arrive at the break even on this trade, you need to add the premium you paid on the call, 22, with the premium you paid on the put, 25, and you come up with 47 points. So in other words, the market would either have to go above 96.47 all the way up here, or below 95.53. Roughly. This is one of the drawbacks of doing a straddle, because this trade, of course, this trade looks too good to be true. If it goes up, you make money. If it goes down, you make money. However, you have it if the market's anywhere between between these two lines, anywhere in this band, you're going to lose some of the premium you paid for the trade. So in other words, you have to have the market really move from where it's at. If the market's at 96 exactly come option expiration, you'll lose on both sides of the trade. However, that's usually pretty unlikely. The market's either going to probably be above 96 or below 96. But you do need the market to be outside of this band to turn a profit. That's without an adjustment. Of course, you always have the option of closing out one of the losing leg and just riding the winner. However, in theory it sounds good, but it's usually a tough decision to make. Okay, so you get filled in the trade, you pay $1,187.50. Now that's the most you're risking. 28 days later, the market's starting to drop, and you're still losing money on the trade. The gains on the 96 put are being offset by the losses on the 96 call. 28 days later, the market continues to go down, hits the bottom of the range, and starts to bounce. You're now turning an $18.75 profit after commissions and cost. 28 days later, market bounces back up, taking back most of what you've made. Now you start to see the market turn a profit for you, and you're turning a $787 net profit. Now this type of trade is very effective if the market does move sharply from where you enter the trade.